Yeah. Stupid. I've got to get 4 hours of work. I can get 4 hours. I can. Oh. Yeah. Last. This is the last. Oh. Oh no. No. Oh. Hello. Fine. You just saw me with terrible hair. Okay. Oh no. Okay. No. Oh no. He still hasn't posted it. Yeah. Okay. Oh. Chapter 9. Me. Oh, yes. Premier financial leverage is a ratio. Okay, we just have a ratio so far. I think for Chapter 9, it's just the ratios. I don't really need to study anything else, right? I know how to calculate weighted average number of common shares. I know how to do that. It's not that hard. It's just ratios. Chapter 9 is just ratios. Freaking stock options, dude. Really? God. Ugh. Ugh. Stop. 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 Why is it so far away? Watch this. Hello! My phone is not charged at all this whole time. Why? Come on. Dude. Dude. You better take a freaking picture. It's too hard to... Dang it, it's not in frame. Why is there a shadow? Dang it. I don't know if this is going to really help much. Okay, we have our race. I'm going to talk about the list. I'm going to study the list of different things. Oh, of course. Oh. I'll just have to memorize the fact that the one photo is operating activities. Stupid shadow, dang it. And then can I just do this whole freaking thing? Please. I hate shadows. Oh my god. Really? Oh, some pictures vertical and some are not. Wait, which one of these is better? There's three of them. They all look the same. Um, Cash outflow is a decrease in asset. No, cash inflow is a decrease in assets. Because if you sell land for cash, what the heck are you talking about? You mean decrease in long-term assets, right? Because your total assets does not change if you sell land for cash. It doesn't. What the heck are you talking about? What the heck? If you issue long-term bonds, you get cash. If you increase stockholders' equity, sell some stock, you get cash. Cash outflow, you increase assets. You mean freaking increase of long-term assets? Oh, God. What are you talking about? The only increase... Okay, every other asset except for cash increasing causes the cash to decrease, right? So that causes a decrease in cash. Decrease in liability, like right here, the decrease in stockholders' equity, payment of cash. Dude, go through the steps. Go through the steps. Show me the steps. I'm gonna have to write it down myself. I have to do it. Why is there no freaking... Dude, they don't have a freaking table that shows what you do. Like, what? What? Basically, you like... Oh, come on. Okay, please have a step-by-step formula as to how to do it. Please. Thank you. Here's the indirect approach. But did they talk about... Did they just talk about the direct and I didn't even follow it, or what? Do we have to know the visual method, the T-account method, the worksheet method? So first, compute the change in cash and cash equivalents. Wow, that's way. Then change the net change in each balance sheet account other than the cash account. Then consider the changes in the balance sheet accounts along with the income statement for the current period and the supplementary information. To illustrate. So for the direct approach, the income statement is adjusted to present the revenue and expense accounts. On a cash basis, Exhibit 1010 illustrates the accrual basis income statement. Adjusted to a cash basis, 1011 shows the statement of cash flows for the company using the direct approach for presenting cash flows from net earnings. Sales is actually described as receipts from customers. So basically we have accrual basis and then we have cash basis. We have sales, operating expenses, operating income, gain on sale of land, income from before tax expense, net income. So sales, you have to decrease you have a decrease in receivables. That's the income. For sales, you consider whether the receivables increases or decreases, and then you either add or subtract it. So like if for receivables, you do the opposite. So for decrease, you add. For depreciate, and then for operating expenses, you consider the depreciation expense, and for depreciation, you actually do the same sign. So if you have a expense, wait just a second here, folks. I need my life. For depreciation expense, any positive, you don't have negative depreciation. It's for depreciation expense, you hello. Wait. Okay, so they have a certain depreciation expense. Their depreciation expense is $4,500. So you subtract depreciation expense from the total number. So subtract depreciation expense, and then do the opposite sign of receivables, change in receivables. For inventories, you actually do the same sign. So if you increase in inventory, you increase 5,000, and then for accounts payable, you do the opposite sign. I wish they had a stinking like my other textbooks had much better explanations of this crap. Like maybe I should just use that instead, because this is stupid. Like they don't even have a formula for how to do it. They just show an example of doing it. So decrease. So they do the opposite for accounts payable, and then for gain or loss, for gains and losses, what you do for those is you do the opposite of them. So if you have a gain, then you subtract that. And then if you have tax payable, then you do the opposite for tax payable. So if you have an increase in tax payable, you decrease by that amount. And then you finally get the amount. So then you have your statement of cash flows. So your cash flows from operating activities, receipts from customers, adjust based on the decrease in based on the change in receivables. Payments to suppliers, you base that on the change. You base that on the depreciation expense, the change in inventories, and the change in accounts payable. And then for net cash provided by operating activities, and then for cash flows from investing activities, you have this proceeds from the sale of land. Do the opposite of what you had. And income tax, for taxes payable, you do the opposite. The only one that you do the same is inventory, change in inventory, and kind of like depreciation expense. Like any positive value of depreciation expense is equal to a negative value of negative. No, so maybe it is the opposite. I don't know. Oh, there was a much better way to think of this. I might go to the other thing I have on my computer. So anyways, hold on. And then for tax. And then everything else is normal, like the investing activities. How the heck did they get 1,500? Where the heck did they get 1,500 from the proceeds on the sale of land? I don't even see that anywhere. Oh, look at this. They do have it as a freaking note at the bottom of the freaking thing. Revenue accounts. Okay, revenue accounts. Add decrease in asset account and increase in liability account. Deduct increases in asset accounts and decreases in liability accounts. Cash inflow. Expense accounts. Add increase in asset accounts and decreases in liability accounts. For one of the adjustments, they actually had an expense. So how does that translate to what they did? So for a decrease in receivables, a receivable is an asset account. So therefore, you do the opposite thing. And for liabilities, you do the same thing because, yeah, but for inventories, what the heck are they doing? They had an increase in inventory, so they added that. But guess what? Hello? This doesn't make sense. They said you're supposed to add and you're supposed to you're supposed to deduct an increase in asset account. There was an increase in an asset. There was an increase in inventories. And then they added 1,000? That makes no sense. What is going on here? What? What are you doing? What? Oh, come on. They said they had an increase in inventories. Then they added 1,000. That's dumb. That is dumb. That is dumb. That is dumb. Why did that happen? Oh. Okay, this is bullcrap. This is bullcrap. The directions say that you must deduct a decrease and add an increase. Deduct a decrease and add an increase. What? This is screwed up. This is totally screwed up. This is totally and completely screwed up. What is going on here? Decrease in receivables. A receivable is an asset. If you have a decrease in an asset, you add it. So they did that one right. Depreciation expense. Just subtract whatever number is in depreciation expense. That's just an extra thing. Inventory is an asset. If there's an increase in an asset, you deduct it. They didn't deduct it. What is going on? Did they do it wrong? What? Oh my God. Expense accounts. Expenses. I think expenses are the exact opposite of revenues in terms of this. So I think I just realized what my mistake was. I just realized it. So I think so for revenues and for expenses it's different. So guess what? These are all expense accounts, so they're doing the exact opposite of what they would do for a revenue account. I'm an idiot. So yeah, I get it now. So basically, for expense accounts, you do the exact opposite thing. But for revenue accounts, you do the other thing. And then tax payable, that's tax expense. If you have tax payable, that's a liability. Since it's underneath expense, what do you do with an increase in a liability? You deduct an increase in liability. So, okay, I get it. This is very confusing, but as long as I do the proper memorization, it's going to be not that bad. Okay. And 11. So, like, the reconciliation thing, isn't that just the indirect method? Like, the direct method is like, do the direct method and then do the indirect method. The indirect method is just do the indirect method. No wonder all companies just do the indirect method. Plus, they like to hide information because. Hello. Wait just a second. It's weird. So we have 5,400 here. Wait. Okay. Oh my god. Now, our other textbook does a much better job of explaining this, and they have a very, very helpful graph to help me. So I'm probably going to go back and look at that instead of this stupid textbook because, I forgot to put it, but I guess it's because I'm still looking for stuff to take pictures of. So all that crap is copy and pasted. Supplemental disclosure of cash flow. So you have to provide some supplemental information. Okay. And I wish they had a freaking. Okay, they do have it, but for one of them, it's a literally. My God, what is wrong with this textbook? For one of them, they literally put it in a footnote to an exhibit. Like, what? That is the worst. That is the worst possible place to put it. Okay, adjustments are for non-cash flow items in the income statement. So the non-cash flow items in the income statement that are removed from the account. Any income statement item that is a non-cash flow item, you remove it from the account. So for example, depreciation expense may be in the cost of goods sold, but so therefore you must remove this expense. Okay. Okay. I can memorize that fact. I'm just going to take a picture of the other table. But it might not be so for this. The other thing I already have. Yay, shadow. This is gonna freaking suck. My phone's gonna die. My phone is gonna freaking die. Okay, we have 2 pictures. Okay, so, of course, there's stylings. Oh! Hello? Can I rotate it, please? Rotate the picture. Wow! Rotate! 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 How do you rotate? Oh my god. Wait, I didn't even check this. See. The other one's better. Yeah, whatever. That's the direct method, and then we'll look at the indirect method. So the indirect method, we have net income, non-cash flow items, add expense, deduct revenues, changes in the balance sheet accounts related to operations, which are usually the current assets and current liability accounts. Add, decrease, okay, gains and losses, and blah, 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 and then there we go. Okay, this is one of the last pictures. There are 2 more pictures to take. This one and then the ratios. Okay, almost done. Oh, really? Really now? Okay. Please stay like this, please. That didn't help at all. Which one's better? They're both basically the same. Okay. Edit. Okay. Save. And then this. Okay, we have. Then we just have the final one, which is the ratios. And then it's going to be a ton of memorization. So it's taking me, so far it's taking me 35 minutes to do all this stuff. They're both basically the same. Again, maybe I don't need to take 2 pictures anymore. Okay. Save. And okay, we have basically all of them. I think all of them work better with my phone sideways. Most of them at least. And even some the ones that don't, they're like, they could do it either way. So, okay, I think we have every picture we need. The only thing is, okay, we have to see if my phone can get charged. Like, my phone is gonna die while I'm studying this. It's so annoying. Or in that case, I'll just have to study sitting down instead of really walking. That's the other difference there. So, all I have to do is memorize all these tables, and it should be good to go. So and we were going to look at the other source of information. We're going to look at our old textbook from management accounting, but actually not the textbook, but the pictures I took from that textbook. I wonder if you can see sensitive information on this page. Let's see where we'd be. I think it'd be under school stuff. I really should put math stuff under school stuff. But anyways, where is it? Hello? It could be in documents instead, but I thought it would just be here. God dang it. This is very risky to be showing stuff I don't want to show. Hello? I thought there was a folder called school stuff. Is it in documents? Why would it be under documents? That's stupid. What? Why did I put it here? Okay. Management accounting. It's probably under here. No, not that. Where is this direct and indirect method stuff? No, dude. Wait. Budget. Capacity. Square root. No. Okay. Should be able to find it. I think I found it. It's these three pictures here. DuPont. Indirect. Oh, here. Indirect. Direct, and direct. Aha! Okay. New. Management, accounting, cash flow statement, direct and indirect. It's a long title. Very good job past me for making these pictures. Okay. All right. Now let's see how helpful these are compared to the pictures I already took so far. And if they are helpful, I will directly transfer them to my phone to study. Okay. So, this is for direct, cost of goods sold. This relates to a cost of goods sold is an expense account. So for an expense account, you add an increase in asset accounts. Okay, so this one is less detailed, unfortunately. So actually I might have to go with the textbook one, but I like the way they put this. I really like the way they put this. Like, basically, instead of saying increase in inventory, just say increase in asset accounts. But I can deal with the textbook way of doing it, probably. I'll be able to figure it out. So yeah, unfortunately, this is not quite good enough, but they had the right idea. I wish the textbook, this current textbook, had something like this too. But and then for sales revenue, you also could just call it for any revenue source, for any revenue account. You do this for accounts receivable, and this for accounts receivable. And instead of accounts receivable, you go with asset account or liability accounts. So that are related to this, because okay, so the only one related to that on here was receivables. On here, for cost of goods sold, where's cost of goods sold? They call it operating expenses? That's so stupid. Wait. So they have inventory and accounts payable, and then the depreciation expense also. They don't even talk about depreciation expense on here. So, weird. So cost of goods sold, you have inventory and accounts payable. And then for sales revenue, you have accounts receivable. I don't know what other accounts would be related to that, like accrued liabilities. I remember the professor just doing something related to accrued liabilities. Selling general and administrative expenses. They don't even have that on here. They don't even... Oh my god, they do! They have accrued liabilities. That was the thing I was confused about. Maybe this is the best source. Because... I mean, what else could there possibly be besides those two different accounts related to this? Any account. And think about it. If there's any account that's similar to this, or similar to this or this, that is related to this but wasn't on this specific table, just think if it's a liability or an asset, and then do what you would do for the liability or asset. So I think these are actually better now that I think about it. Maybe I'll study both and see which one helps better. But anyways, sales, so general and administrative. For some reason, this example doesn't even have this. I have no idea why. And then we have the indirect method. Okay. So we have net income, add depreciation expense. For non-cash flow, theirs is a more generalized thing. Like this one just has depreciation. This one has non-cash flow items, add expense, deduct revenue. This one has changes in current assets and current liabilities. This one says changes in balance sheet accounts related to operations, asterisk. These are usually the current asset and current liability accounts. So then you do all those. And then we have gains and losses on the income statement. This one does not include it, unfortunately. So I think the textbook is a little bit better in this case. It says add the loss and deduct gains for that. And then finally you have the net cash provided. So, okay. I feel like this was a little bit incomplete. Like they don't have enough stuff on it. But like these, I feel like they're helpful because they actually tell you which accounts are related to what. So we'll probably copy these three over, but not this one, because this one's like a not as good version as the one in the book. So, but these three are a little bit better because they tell me that, sales revenue is related to accounts receivable, cost of goods sold is related to inventory and accounts payable, and then selling general and administrative expenses are related to prepaid expenses and accrued liabilities. So, anyways, so basically for revenues accounts and for expense accounts, you do the exact opposite of each other. So that's the memorization tool. I bet none of this is even going to be on the quiz. This is going to be a waste of time. I just hate it. I wish our study guides were better. Like, why can't we have study guides instead of studying 10 trillion things that are not going to be on the test? Like, okay, if you want us to learn more stuff, so you purposely give us too much stuff to learn, so we learn all that stuff, and then we take a test that only has some of that stuff, guess what? It's frustrating. Why don't you just have a longer test that has more information on it? Test us on more information, and at least tell us all the information we need to know for it. I would rather have a longer test, even if it's like a 3-day long test where you have like 2 hours per, I don't freaking care. Just tell us what we need to know for the test, and I'm good to go. Otherwise, I hate it. I'm so frustrated when I have to waste so much time studying stuff that's not even going to be on the test, but I have no idea that's not going to be on the test because they even charge like 4%. Okay, now I'm pretty sure we have everything we need to study for our quiz. So, I'm just study and see how long my phone lasts before it dies, and then I have to sit down to study. But maybe I will be able to finish the study before then. So I have to study 9 pictures. There's so much information. Okay, what do we got? We got all of our ratios from chapter 9. And this is going to take way longer to study. This stuff. Oh my gosh. Alright, what's the degree of financial leverage? The degree of financial leverage is the earnings before interest and tax divided by earnings before tax. So earnings before interest and tax divided by earnings before tax. What is the all-inclusive degree of financial leverage? Our professor specifically said we don't have to use this. But I can't really trust my professor. I'm sorry to say I can't trust him because he has put stuff on test that's not in the textbook at all, let alone stuff that's in the textbook, but he says it's not going to be at the test. But anyways, the all-inclusive one is earnings before interest, tax, non-controlling interest, equity income, and non-recurring items divided by earnings before tax, non-controlling interest, equity income, and non-recurring items. So all they do is add non-controlling interest, equity income, and non-recurring items, and then for the top it has interest, and the bottom it doesn't have interest. So anyways, earnings per share is the net income minus preferred dividends divided by weighted average number of common shares outstanding. The price to earnings ratio is the market price per share divided by the diluted earnings per share before non-recurring items. And then the percentage of earnings retained. The percentage of earnings retained is basically like the percentage of earnings that you have retained compared to the total amount of net income or whatever. So, because some of it net income before non-recurring items minus all dividends divided by net income before non-recurring items. The dividend payout is the dividends per common share. The dividends per common share divided by the diluted earnings. So remember, it's not the total dividends, it's the amount of dividends paid per share. So divided by the diluted earnings per share before non-recurring items. What the fuck? Dividend yield. The dividend yield is my goodness. Dividend yield is the dividends per common share divided by the market price per common share. The book value per share is the total shareholders. Okay, so I saw something in the book. I remember being confused by this one time because we had a question that we had to do or something where we had to calculate that, but they didn't give us that information. Like, where was that? Hello, you stupid textbook. You stupid textbook. Stupid! Where was that? What happened with that? What was that? Like, we had a question where I think it was talked about in class, I guess, but the book value per share. Oh my god! They didn't give you that same information. You had to do something else to calculate the book value per share. Oh. Oh. Well, there better not be stupid stuff. I am frustrated when the book tells you a formula for something, and then you have to do something else besides that formula to solve a question relating to that thing. God dang it! God. Book value per share is the total shareholders' equity minus preferred stock equity divided by the number of common shares outstanding. The materiality of options. Is the net income before non-recurring items, not including option expense. Not including option expense. Minus the net income before non-recurring items, including option expense, divided by the net income before non-recurring items, not including option expense. Oh, man. Now, what are operating activities? Operating activities include all transactions and other events that are not investing or financing. Cash flows from operating activities are generally the cash effects of transactions and other events that enter into determination of net income. Here are the typical cash inflows of operating activities. We have the sale of goods or services. We have return on loans, which is interest. You earn interest revenue. That is a cash inflow. The return on loans interest. The return on equity securities, dividends. If you buy stock in one of the companies and then you get dividends, that's a operating activity income or a cash inflow. And other operating activities. The cash outflows for operating activities are payments for the acquisitions of inventory, the payments to employees, and the payments to government's taxes, and payments of interest expense is counted as operating. And the payments to suppliers for other expenses. And now we have investing activities. Investing activities include lending money, so loans actually count as an investing activity. Yeah, I guess that makes sense. So lending money, and also collecting on those loans, and acquiring and selling investments and productive long-term assets. So typical cash inflow from an investing activity is a receipt from loan collected. So basically, anything having to do with a long-term loan, I guess, would be counted as investing. If you loan money and then if you collect the loan back, that counts as investing. An inflow is from the sale of a debt or equity security of other corporations. If you buy debt and equity securities, don't they just mean stocks and bonds? Oh. If you sell debt and equity securities of other corporations, if you have the sale of property, plant, and equipment, if you have typical cash outflow investing activity, is loans to other entities, purchase of debt for equity security of other entities and the purchase of property, plant, and equipment. And then financing activities are cash flows related to liability and owner's equity. The typical cash inflow for financing is from the sale of equity securities / issuing stocks, cash flows. And also, if you issue a bond, does that count as a security? No. Equity securities are stocks. Think about it. If you issue equity securities, if you sell equity securities, if you sell a bond, mortgage, note, and other short or long-term borrowings, if you have an outflow, you have payment of dividends as financing, reacquisition of the firm's capital stock is outflow, and payment of amounts. What is that? So basically, if you sell a bond, then that means that somebody is money in the bag. That's considered finance. So if you give a loan and receive a loan, if you give a loan and then get the loan back, that means you're investing. If you get a loan from someone else and then you repay them the loan, that's financing. Okay. And then now, how do you do the direct method of cash flow statement? Okay. So for direct method of cash flow statement, for revenue accounts. Okay. For revenue accounts, you have either changes in asset accounts or changes in liability accounts. And what you do is the opposite for assets and the same for liability. So for assets, you add decreases in assets and you deduct increases in asset accounts. For revenue accounts. And for liabilities, you do the same, which means you increase liability accounts and decrease them. And you add increases in liability accounts and deduct decreases in liability accounts. Holy. Wait, I'm confused. They have the word cash inflow and cash outflow at the bottom. Chart. What the heck are they talking about? Oh, so I guess that means after you've done those calculations, you have the cash inflow from revenue. Oh, I get it now. I'm an idiot. I don't know why. Yeah, basically, I forgot to include the XXX's on the end. Like you have revenues, add this stuff, decrease this stuff, then you have the cash inflow. Then expenses, add this stuff and decrease this stuff, and then you have the cash outflow. So, okay. Well, I should have included that, but oh well, it's fine. See, my very optimistic estimate for studying was 1 hour. Yeah, it's going to be longer because it took like 40 minutes to just get all the stuff to study, and now I just have to study. So basically, assets are opposite. For revenues, assets are opposite and liabilities are same. So for expenses, it's the exact opposite of revenues. So assets are the same and liabilities are opposite. So for revenues, like the only thing I have to memorize here's the only thing I have to memorize. First of all, I have to memorize either asset like only one thing from the revenues. I have to memorize one fact from the revenues. And then the fact that the revenues and expenses are opposite, that's literally it. And the fact that assets and liabilities are opposite each other, revenues and expenses are opposite each other, therefore, and then all you have to do is memorize one fact. So I could just memorize the fact that revenues, assets are opposite. That would help me to do every other calculation. So basically for expense accounts, for revenue accounts. And also the fact that for any non-cash flow account, wait, that's for something else. Well, actually, and then for any non-cash flow items, you remove it from the account. So in addition to this information, for any non-cash flow item in the income statement, you remove it. If you see anything, there's depreciation expense. There might be other non-cash flow items, but I don't know if there is going to be. But especially depreciation expense, which is related to operating, which is related to cost of goods sold, right? So here, memorize the fact that if there's a non-cash flow item, then you remove it. And then revenues and expenses are opposite, assets and liabilities are opposite. And the one fact I would like to memorize, should I just memorize the fact that for revenue accounts you add decreases in asset accounts? I don't know which one to memorize. I think that's the easiest thing. It's the first one there. So for revenue accounts, you do the opposite sign for assets. For revenue accounts, you do the opposite sign for assets. That's literally all I have to know. So, and the other two facts I mentioned are very, very easy to know subconsciously. Okay. Now for the indirect statement, you have a series of steps you have to follow. First, you have net income. Then you have the non-cash flow items from the income statement. You add expenses and deduct revenues. Very simple. Then changes in balance sheet account balance related to operations, which are usually current assets and current liability accounts. So, and it's not all current liabilities and current assets, only ones related to operations. Only ones related to operations. So, for that one, you do the assets and liabilities, and you have the assets are opposite sign and the liabilities are same sign. Then you have gains and losses that are related to investing or financing activities. What? Well, I guess that makes sense because it's on the income statement. You have to include it. So any gains or losses, you have to do the opposite of what they are. Again, and then you end up with your answer. Now we will look at the ratio for chapter. We have the operating cash flow divided by current maturity. Well, for 3 of the 4 ratios, the name of the ratio is just the ratio. So I don't need to memorize the name of the ratio for 3 of them. The only one where it's different is the operating cash flow per share. Anyways, we have the operating cash flow. We have the operating cash flow divided by operating cash flow divided by the current maturity of long-term debt and current notes payable. What does that freaking mean? The current maturity of long-term debt? Wait, I'm not so. This indicates the firm's ability to meet its current maturities of debt. Where do you find this info? Nike. Oh, you idiot. It's literally called maturity of debt in the cash flow statement itself. There's maturities of short-term investments, but that's not what we want. We current maturities of long-term debt and current notes payable. So where would that be located? No. Where did they get this information? They have 300. Where's current notes payable? Look at this. They have current maturities of long-term debt, and right here. So they have in the notes they have the current maturities. 2010 it's only 7. 2011 it's 200. What? Okay, but where'd they get these numbers, dude? I don't know where you're supposed to find this. Like, in the income statement. Or, I mean, in the statements. Because, okay, what about note payable? Where do you find notes payable? That's a long-term liability, though. Well, it's current notes payable. Where's their short-term liability? Here, we do have it here. We have notes payable. Here, I found it. Cool. Okay. So, the total amount of notes payable for 2010 is 139, plus 7 for long-term debt is 146. That's the number they should have. Yes! I figured out how to do it. I'm a genius, not really. And then you have 200 plus 187 is 387. Yes, I am so smart. So what you do is go to the notes. Here's how you figure out the current maturities. So what you find out is you go to the notes about long-term debt, you look at the current maturity. Then you go to the note about short-term borrowings, and you look at the notes payable. Add both of those together, and you get the number. Yes, I figured it out. I am so proud of this. Okay, who cares? Anyways, current maturities of long-term debt and current notes payable. Okay, I know how to do that now, so good. All the other ones should be self-explanatory. Operating cash flow, very simple. You just look at the operating cash flow. Like, it's just listed there. Operating cash flow. Divided by current maturities of long-term debt and current notes payable. So this indicates the firm's ability to meet its current maturities of debt. I don't know if I feel like standing up. In which case I'll try charging. Oh, jeez. So, like, I don't know if this would even be adequate. It might be on a test, but it's asking me to calculate that ratio. I know how to find the information for the ratio, but maybe he'll just give you the information, and this was a waste of time. God damn it. Okay, what's the other one? Now we have operating cash flow per share. Wait, hold on a sec. There was another one before that, wasn't there? Oh, there was. I skipped it by accident. So actually we have operating cash flow divided by total debt. So first we have operating cash flow divided by current maturities of long-term debt and current notes payable. And then we have operating cash flow divided by total debt. which indicates a firm's ability to cover total debt with the yearly operating cash flow. And total debt is easy to find. It's literally just the total liabilities, right? And then we have operating cash flow per share. So we have operating cash flow per share. This one indicates the funds flow. The funds flow per common share outstanding. So in the short run, this ratio is a better indication of the firm's ability to make capital expenditure decisions and pay dividends than is earnings per share. It's better in the short run, at least, I guess. So basically, we have operating cash flow minus preferred dividends. It's similar to the other one because the other one is net income minus preferred dividends. But then this one uses diluted where the other one doesn't. This one uses diluted weighted average common shares outstanding. And then we have operating cash flow divided by cash dividends. And this indicates a firm's ability to cover cash dividends with the yearly operating cash flow. So cool. So I think that's all the ratios, right? So then finally, we're just looking at the direct and indirect methods again. So we have sales revenue. So for revenues, I know this already. You add, so you do the opposites for assets. You do the opposites for assets, and you do the same for liabilities, but this one only includes receivables, but you do the opposite for assets. So, and it involves accounts receivable usually. Sales revenue usually involves accounts receivable at asset, so you do the opposite of the change. There. Then for the cost of goods sold, you actually do the opposite of what you were doing before. So for assets, you do the same, and for liabilities, you do the opposite. And what assets and liabilities are involved? Well, we have inventory, and then we have accounts payable, right? Yes. That's exactly what you were doing. Okay. And then finally, we have selling, general, and administrative expenses. Since it's an expense, you do the same for assets and the opposite for liabilities. And the ones you're going to look at are prepaid expense. What prepaid? Hold on. What? Prepaid expense is an expense. What are you doing? What is this? I'm a stupid idiot. Prepaid expenses is an asset, you idiot. Prepaid, it just has the word expense, so it feels like it's not an asset, but it is an asset. I was just confused. But prepaid expense is an asset, and since it's an expense account that you're dealing with, you do the same sign. And the other thing related to the selling, general, and administrative is accrued liabilities. And for assets, you do the same. For liabilities, you do opposite. So, yeah. And then we have, 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 I already did all three. So I only went through the stuff once. I have to go through it again. But it won't take as long to go through it a second time. I can't believe I'm actually going to spend this whole entire time studying for the quiz. Seriously, I was going to do some other homework, some work on the project, but instead I'm spending the whole time studying for the quiz. God dang it. But this will be very valuable for studying for the test at least, but my God. I bet this isn't even going to be on the quiz. I'm tired, but what is the degree of financial leverage? Let's see if I can list it from. I don't know what it is, dude. I don't know any of these ratios. The degree of financial leverage, I don't know what it is. Oh, I think I know what it is. It's earnings before interest and taxes divided by earnings before taxes. What is the all-inclusive degree of financial leverage? It's the earnings before interest, taxes, non-recurring items. Yeah, but guess what? What about, I don't think they say non-recurring items. They just say non-controlling interest, equity income, and something divided by the same exact one, except you don't include interest in it. So earnings before interest, tax, non-controlling interest, equity, income, and non-recurring items. Guess what? Non-controlling interest and equity income are recurring items. Idiot. Non-controlling interest, equity, income, and non-recurring items. Now, what is earnings per share? Net income minus preferred dividends divided by, or is it preferred stock? Oh, I hate my weighted average of common shares. I hate myself. It's actually preferred dividends. Dude, stupid idiots. For the earnings per share, you subtract preferred dividends, and you then divide it by the weighted average number of common shares outstanding. What is the price to earnings ratio? The market price per share divided by the earnings per share. But actually, they have a different earnings per share. They have like diluted earnings per share or something. So what's the difference? They have diluted earnings per share before non-recurring items. Okay, now what is the percentage of earnings retained? Oh, dang it. It's net income before non-recurring items minus all dividends divided by net income before non-recurring items. And then what is the dividend payout? Is the dividends per common share divided by diluted earnings per share before non-recurring items. So the dividends payout and the price to earnings ratio are very similar. The only difference is the numerator. Instead of the numerator being the market price per share, it's the dividends per common share. And what about dividend yield? It is the dividends per common share. So the dividend payout and dividend yield are similar because they both have dividends per common share as the numerator. But for dividend yield, you divide it by the market price per common share. What is the book value per share? Total shareholders' equity minus preferred stock equity divided by the number of common shares outstanding. Why the heck do they use number of common shares outstanding? Shouldn't it be average? No, it doesn't need to be average because all of these are income statement. I mean, all of these are balance sheet items. So anyways. And then Now, what is the materiality of options? It is the net income before non-recurring items, not including option expense. Minus net income before non-recurring items, including option expense, divided by net income before non-recurring items, not including option expense. So there's three things. The only difference there's two things, numbers in this ratio. The only difference between them is one of them includes option expense and one of them does not include option expense. The one not including option expense is subtract. You subtract the including from the not including, then you divide it by the not including. Oh my gosh. And now, what is an operating activity? Sale of goods and services, return on loans is interest, and return on equity securities is dividends. And a payment for an acquisition of inventory, a payment to employees, payment to government taxes, payment of interest expense, and payment to suppliers for other expenses. Investing activities, and remember, the other thing is, if you give a loan and then get your loan back, that's investment. Makes sense, because if you give a loan, that means you're investing in something. And then, if you sell or purchase equity securities. If you sell or purchase equity securities, that's investing. If you sell or purchase equity securities, it's investing. If you give your loan or get your loan back, that's investing. And if you sell or buy long-term assets, but they just list property, plant, and equipment, so whatever. If you sell or buy property, plant, and equipment, that's investing. Then, if financing activities include the sale of equity securities, of your own equity securities, because if you sell of other corporations, it's investing. If you do it of your own company, if you sell your own equity securities, that's called financing. And then if you sell your bonds, mortgages, notes, and other short or long-term borrowings, that's also financing. And then if you have pay a dividend, then it's financing. And if you reacquire your stock, it's financing. And if you pay amount borrowed, that's basically the same thing as if you sell your bond and then you buy it back, right? Or something. Because bonds are basically just other people lending you money, and when you pay them back the money, that's considered part of financing, because what's revenue accounts? Okay, how would you do the direct method? You do the direct method like this. For a revenue account, you do the opposite for assets. And then all of it logically follows from that. That's all you have to know. For revenue accounts, you do the opposites for assets. That's literally all I have to know. For the indirect method, what you do is net income. Then you for non-cash flow items, you add expenses and deduct revenues. And then you do the changes in balance sheet accounts related to operations, which is usually including current liabilities and current assets. And you do the same thing that I already memorized before, which is you do the opposite for assets and the same for liabilities. And for gains and losses, you do the opposite for both. You do the opposite of them. So if you have a gain, you subtract. And if you have a loss, you add. And then you get your net cash provided by operating activities. And now we have four ratios. We have the operating cash flow divided by the current maturities of long-term debt and current notes payable. So operating cash flow divided by current maturities of long-term debt and current notes payable. And this indicates your ability to meet your current maturities of long-term debt and current notes payable with operating cash flow. And the next one is operating cash flow divided by total debt. And that shows your ability to meet. And what is the formula for operating cash flow per share? Well, it's very similar to earnings per share. So you do operating cash flow minus preferred dividends divided by the diluted weighted average number of common shares outstanding. Yes, I got it right. And what's the formula for operating cash flows divided by cash dividends? Okay. Oh my gosh. For the direct method for the direct method of cost of goods sold, you have, what are the involvements in the cost of goods sold? Well, you have inventory and you have accounts payable. For cost of goods sold, it's an expense. So you actually do the same for assets, and the asset is inventory. So you add the increase in inventory, and you add the decrease. You add the decrease in accounts payable. What about selling, general, and administrative expenses? Well, what you have are prepaid expense, which is actually an asset, and you also have accrued liability. And for this one, it's an expense, so therefore you add the increase in prepaid expense and add the decrease in accrued liability. And for sales revenue, usually the only account you're looking at is accounts receivable. So for sales revenue, you add the increase. You add the decrease in asset. You add the decrease in accounts receivable. So, okay, I got that. Back to ratios. So, what's the degree of financial leverage? What is the degree of financial leverage? Can I even say it? Oh, I can. It is earnings before interest and taxes divided by the earnings before tax. What is the all-inclusive degree of financial leverage? It's the earnings before income, the earnings before interest, taxes, non-controlling interest, equity income, and non-recurring items, divided by the earnings before taxes, non-controlling interest, equity income, and non-recurring items. Yes. Now, what is earnings per share? The earnings per share is net income minus. Oh, I think you have to do net income before non-recurring items. I'm pretty sure that's what you have to do, right? It's net. I can't remember. Dang, let me look. For earnings per share, no, it's just regular net income. God damn it. For earnings per share, it's net income minus preferred dividends divided by the weighted average of common shares outstanding. And now, what is price to earnings ratio? Well, guess what? It's the market price per share divided by. Did I say diluted? I can't remember. I think it's diluted. earnings per share before items or something. Yes, that was completely correct. Now, what is the percentage of earnings retained? The percentage of earnings retained. 5 minutes. The percentage of earnings retained is net income before non-recurring items minus all dividends divided by net income before non-recurring items. Yeah, I'm right. Now, what is the dividend payout? The dividend payout is the dividends per share divided by it's the dividends per share divided by something. Okay. What is it? The dividend payout is the, so remember, if you're talking about dividend payout, the denominator has to do with the earnings per share. So the dividend payout is the dividends per share divided by the diluted earnings per share before non-recurring items. And it's dividends per common share. What is the dividend yield? Dividends per common share divided by the market price per share. Common share. God damn. What is the book value per share? Total shareholders' equity minus preferred equity divided by, is it the number of, it says number of common shares outstanding. The preferred stock equity. What is the materiality of options? Is this one net income again? Yes. Okay. It's net income before non-recurring items, not including options expense, minus the net income before non-recurring items, including option expense. And if you include option expense, then you don't even really need to say including option expense. And then the divided by net income before non-recurring items, not including option expense. Okay, now I think I know what operating, investing, and financing activities are now. It makes logical sense. So now, and I also know how to do the cash flow statement using the direct and indirect method. Actually, the indirect method, you do net income, then non-cash flow items, then changes in balance sheet accounts related to operations, gains and losses on the income statement that are related to investing or financing activities. I think I get that. Now the other ratios are the stinking operating cash flow divided by current maturities of long-term debt and current notes payable. And then we have operating cash flow divided by total debt. And then what's the operating cash flow per share? It's operating cash flow minus preferred dividends divided by the weighted average number of common shares outstanding. No, they use diluted weighted average common shares outstanding. Dang you. And then we have the operating cash flow divided by cash dividends. And that's it. And what is the degree of financial leverage? And earnings before interest and tax divided by earnings before tax. What is the all-inclusive? Earnings before interest, tax, non-controlling items, equity, income, and non-recurring items. I mean, non-controlling interest, equity, income, and non-controlling items divided by the earnings before tax, non-controlling item, non-controlling interest, equity, income, and non-recurring items. What is the earnings per share? Is the market price per share, average market price per share divided by the Wait, what am I doing? Earnings per share, you idiot. Earnings per share is net income minus preferred dividends divided by weighted average of shares outstanding. What is price to earnings ratio? Market price per share divided by the earnings per share before not diluted earnings per share before non-recurring items. What is the percentage of earnings paid? Net income before non-recurring items minus all dividends divided by net income before non-recurring items. What is dividend payout? It is the dividend per common share divided by the diluted earnings per share before non-recurring items. What is the dividend yield? The dividend per common share divided by the market price per common share. What is the book value per share? Total shareholders' equity minus preferred stock equity divided by number of shares outstanding. What is the materiality of options? It is net income before non-recurring items, not including option expense, minus net income before non-recurring items, including option expense divided by net income before non-recurring items, not including option expense. Is this the only one left? Non-cash flow changes in balance sheet accounts. And gains and losses on the income statement that are related to investment. Operating cash flow divided by current maturities of long-term debt and current notes payable. The operating cash flow per share, operating cash flow minus preferred dividends divided by diluted weighted average. This is percentage. I don't feel like doing it. I don't. That'd be fun. Stop. Stop it, you stupid lag. Stop lag, stop lag, stop